everyone. In this video, I'm going to talk about how I made $30,222 in 30 days by investing into one undervalued stock. And I did this without day trading, checking the news 24/7 while working a 9-to-5 job. Here's video proof of this on my Instagram, $30,222 on my Robinhood account. I post video proof of this every single day on my Instagram. Go ahead and check that out in the link in the bio, or check out my Instagram at TrinInvests. So who am I? My name is Daryl Trin. I currently live in Los Angeles, California. I am a physician assistant. I've been trading for the past 8 years. I've lost a lot of money and I've made a lot of money in the stock market. And because of that, I've learned a lot since then. I know what's right. I know what's wrong in the stock market, what works, what doesn't work. I'm an investor and a trader at heart. I'm very confident that any beginner that watches this 40-minute video, if they follow the strategy that I outline in this video, they themselves can achieve a 6-figure portfolio. This case study will show you how I made $30,222 in 30 days by investing into one undervalued stock. There's no day trading, no options trading, or checking the news 24/7. All I did was find an undervalued stock, pre-plan my entries and exit points, and profit. The goal of this case study: by implementing the things in this case study, you yourself will be able to become a high-level investor. Once you go through this whole video, you'll be a 6-figure investor. Most investors trade like retail investors. You need to become an institutional investor, have the mindset of an institutional investor like Warren Buffett, Charlie Munger, and so forth. So what am I going to outline in this video? There are 5 main parts that we'll be going over in the next 40-ish minutes. There'll be subcategories to each part. Part 1 will be going over the mindset of a 6-figure investor. Part 2 will be finding the undervalued stocks. Part 3 will be technical analysis. We'll be setting pre-planned entries and exits. Part 4, risk management. And lastly, profit, rinse, and repeat. So there are 4 main problems for people that invest. Every person that starts investing suffers from these problems. Number 1, they don't have a goal. Number 2, they don't follow a strategy or system. Number 3, they are not able to control their emotions. Number 4, they don't manage the risk. By fixing these problems, you can become a profitable investor. I knew this from being in the market for the past 8 years. These problems always were my downfall when I lost hundreds and thousands of dollars. If you're able to stick with a system, if you're able to control your emotions, if you have a goal, if you're able to manage your risk, you will be able to solve all of the things that result in an unprofitable investor or trader. Number 1, they don't have a goal. A lot of people that start trading or investing don't have a clear goal in mind. Imagine you were driving without a destination. You wouldn't know where you're going, or you'd be driving for hours with no destination. Having a goal gives you a clear direction of the actions or the plays that you need to execute to get there. If you don't, you're just going to lose a lot of money, and it's like throwing spaghetti at the wall. Number 2, they don't have a system or strategy. Most people are what I like to call running and gunning. They're investing without any sort of strategy. They throw their hard-earned money into a stock and just hope it goes up. Or they follow someone else's signal or call out and just hope for the best. This is simply gambling. You need to have conviction in your plays. You do not want to gamble in the stock market. You will lose a lot of money. This is why people lose all of their money investing. If you don't execute off of your own plays, have the level of conviction, going through the fundamental analysis, doing the technical analysis, and executing your plan just the way you want to do it, you will not be profitable in this market. Market makers feed on your emotions, and if you don't have that level of conviction, you will be stopped out of your plays. Number 3, this goes along with what I said before. They can't control their emotions. This is so common. Humans by nature are emotional people. We tend to make most of our decisions emotionally. When we're down in a position, say 4-5%, we tend to sell out of our positions. We can't stomach the pain or seeing us down in that position. We just feel like we're just sinking more of our hard-earned money down the drain every single day. They're not able to stomach the lows. When we see a stock go at its all-time high, we tend to chase the stock, and then you end up getting caught in a reversal. That allows you to be so caught up in your emotions. If you're trying to make any real money in the stock market, you need to get rid of all your emotions when it comes to investing. Stick to the strategy and play with no emotion. Number 4, don't manage their risk. One of the most common mistakes I see people make is they do not manage their risk. They don't buy when they're supposed to buy. Think about it. When a stock is going down, that is when you should be buying. Many people do the opposite. They get fearful and they do not buy when they should be buying in dollar costing averaging. They don't sell when they're supposed to sell. Many people get greedy. They think there's going to be a breakout and they do not sell out of positions hoping for some extra profits. Ultimately, you need a goal. You need to stick to your strategy. You need to play with no emotion. These problems are the reason many people do not know how to manage their risk. When you're able to fix these problems, you're able to manage your risk, preventing you from losing money. So what is my strategy? Number one, I evaluate undervalued companies. This involves using the Warren Buffett style of fundamental analysis. We're going to be finding value in the stock market. Think about it like this way. The market is a voting machine in the short term and a weighing machine in the long term. What does that mean? It means in the short term, a lot of how a stock price moves is purely off of sentiment at the time. But over time, when things get oversold, that sentiment will ultimately shift over and play into the fundamentals. That's why it's so important to just stick to the fundamentals of a company. Understand its revenue, understand its bottom line, its free cash flow, its margins, and so forth. That's what you guys need to be sticking to. And after you guys evaluate those undervalued companies and you deem these companies are worthy to start trading and investing into, we delve into the technical analysis. This technical analysis, we don't use a billion different complicated indicators. We use a couple indicators that has been proven time and time after again to be successful, because that is what institutions trade off of. I'm talking about your supply and demand. I'm talking about your Fibonacci levels. Then after our technical analysis, we'll start executing our trades. We'll set our entries and exits. Everything is pre-planned, in and out. There's no emotion, no extra time is needed. If it hits our profit target, great. We take our profits, move on to the next play. If it fails the level, we'll simply just dollar cost average into the next area of demand and then let time do its thing and profit from there. That brings me to the last step: profit, rinse, and repeat. We aim to make 5 to 10% per month conservatively. This is going to allow us to be able to consistently and predictably make money in the stock market. Remember, we're in the game of not losing our money. We're here to multiply our wealth. Making that 5 to 10% per month in an account that is growing time and time after again is able to compound your wealth to over 6 figures in account value. Part 1, this is going to be the mindset of a 6-figure investor. Most people invest or trade emotionally. They have no idea how to control their emotions, which results in them losing lots of money. That's why it's the first key that you need to work on. If you cannot control your emotions in this market and mindset while investing, the strategy will not work. It will not work in any sort of strategy. You need to be able to maintain your emotions and not get caught up in your feelings. So everybody knows it. Anyone that's been investing into the stock market knows how much of a roller coaster of emotions things can be. But if you're able to calm that down, you're not going to lose your money. You'll be able to make money. Sell when there's a lot of greed, buy when there's a lot of fear. That is the famous Warren Buffett saying. If you allow your emotions to impact your decision making, you shouldn't invest at all. So this is an illustration of what happens to the common trader investor. They start entering out of greed, right? When a stock is trending upwards, they end up caught in a resistance level and things start trending lower. They then exit out of panic because they have fear that the stock is just going to keep going down and down and down, only to be at a level of support. And then many just exit out of fear when they're just simply break even. You need to have a plan that is going to allow you to play without these emotions, buying at these demand levels, and then playing off of those demand levels. If those levels break, that is what's going to allow you to become successful in this market. You guys need to not follow the crowd. You do not want to be like every other retail trader that loses hundreds and thousands of dollars. We hear it all the time. 90 to 95% of traders or investors are not successful. They're not profitable. You need to think like a contrarian thinker. You need to go against the crowd. If you're doing what everyone is doing, how do you expect any different results, right? So for example, when people are buying, you should be selling. That's when people are getting greedy. That's when you should sell. When people are selling out of positions, you, instead of being fearful, are going to be looking at it as opportunity, as a buy opportunity. This is an illustration of the emotional cycle of investing. Everyone that trades or invests are going to be having these feelings. If you guys understand these feelings and understand that these market makers are going to play off of your emotions, this is going to foolproof you against getting stopped out, playing into their emotional roller coaster and profit time and time after again. So what does this illustration depict? Here is the hope, optimism, belief, thrill, and euphoria when a stock continually rallies and rallies and rallies. Think about the crypto market at one point, right? It just kept going up and up and up. Everyone was buying. People were going into margin, buying into positions. And then things fall back down and people think that's just a temporary cool down in the stock market, only to find that the stock market continually drops and drops and drops. People who are in margin call are getting extremely anxious, they have denial, they have panic, and then ultimately they end up capitulating out of their positions. They end up selling out of positions because they can't handle the emotional roller coaster. This is what the market makers feed off of. They get you angry, they get you depressed, only to find that if you play the long-term game, if you stuck to a strategy that incorporated playing into an area of demand, not buying into euphoria, into a major uptrend into a position, buying stocks at a low, that is what's going to make you become profitable in this market. So like I said time and time after again, you do not want to be like retail traders that lose hundreds and thousands of dollars in the market. Most retail traders are not profitable. You need to think like a contrarian thinker. You need to go against the crowd. When people are buying, you should be selling. When people are selling, you should be buying. This is how you create consistency in investing. This is how you create a bulletproof track record when it comes to investing. Buy low, sell high. Simple as that, but many retail traders are not able to do that. Part 2, finding these undervalued stocks. Undervalued stocks are the key to making crazy returns inside of the stock market. If a stock is undervalued, you tend to have a huge upside and low downside. The easiest way to find undervalued stocks is to stick to the S&P 500 companies. These are companies that if the stock market were to crash, or for whatever reason, a lot of demand is start to decrease, these stocks would be able to survive in the stock market. An example of undervalued stocks can be Baba, PayPal, Boeing, Tesla, Square, and so forth, right? These are huge companies that have huge moat, huge brand value, that you'd be extremely surprised that they wouldn't be around here for the next 4, 5, 10 years. So how do we evaluate these stocks? What exactly make these stocks undervalued? These are the criteria that I go under. Number 1, they need to have a moat. You want companies that are of the future. You'd be surprised if they're not around in the next 5 to 10 years. I'm talking about huge brand values. The reason why you need to have a moat is because there's going to be a lot of competitors in whatever industry you want to get into. If they have a moat, many of those competitors are not able to compete just because of their huge brand value. Number 2, they need to have a positive free cash flow. What does that mean? It means that the company is profitable. Overall, the expenditures are less than what they are able to generate in cash. Number 3, the RSI has to be below 30. This is when a stock is trading at an oversold level. You do not want to simply just go off of an RSI below 30 to enter into a play, but an RSI below 30 is a great start to understand if a stock is oversold at a certain point. Number 4, PE ratio has to be around historical lows. You want to compare the company's PE ratio from its history. If a stock typically trades around a PE ratio of about 30 and starts trading at a PE ratio about 15, that is a very good chance this stock is trading at an undervalued level. Number 5, they should be a simple and predictable business. You want companies that have shown strong revenue time and time after again, growing revenue. You want to be able to predict this company's revenue year after year after year. If the stock fluctuates from one year making 10 million and then loses 5 million and then makes 20 million, that is not a simple and predictable business. You want a company that is steady. Number 6, they should have a dominant market position. This goes along with my point with number 1. They need to have a moat, right? They have some dominant position in the market where a lot of competitors can't take over. Think about your Apples, think about your Boeings, right? There's so few competitors in those landscapes that they have that sort of monopoly in the market. Number 7, they should have a large barrier to entry. This goes along with the moat. This goes along with the dominant market position. By having a larger barrier of entry, A lot of competitors can't take over, and if competitors can't take over, margins are able to stay intact and even growing at some point. For example, an undervalued stock would have to be Alibaba. Let's go over case in point of the moat. China is going to protect their domestic companies, of in which is Alibaba, from foreign competition like your Amazons, right? Number two, they have a positive free cash flow. Free cash flow is actually one of the best out of any other company. If you compare Alibaba's free cash flow to Amazon's, you'll actually see that it's multiple times better than Amazon's, but trading at severely lower valuations. Number three, the technical analysis. The only time we're going to hop into the technical analysis is after we found a fundamentally undervalued stock. We don't want to use complicated indicators and make the whole process complicated. We only use it to pre-plan our entries and exits. So the different indicators that I use are the Fibonacci levels and Elliott waves. It should be noted that you don't want to overcomplicate this at all. If you're good at one, stick to it and use it effectively. Fibonacci retracements. I typically use Fibonacci retracement when it comes to setting my pre-planned entries and exits. Since I'm value investing or trading, I typically buy at deeper retracement levels at the golden zone of about 50% to 61.8%, right? In terms of Fibonacci retracements, you want to identify a swing low to a swing high. Remember that we do not want to buy stocks as it continually trends up. We want to find a deeper retracement, and that deeper retracement is going to be around this golden zone, about 50 to 61.8%, or around the 50% being used right here at the golden zone. You never want to use Fibonacci levels as a sole indicator. You guys need to locate other confluences, other thing that supports your thesis within that level to buy into. And what are those confluences that I use? Supply and demand levels. That's a huge technical indicator that you guys need to use and understand. That is what institutional investors and traders go off of predominantly. Number two, bullish divergences, particularly the RSI divergences. Confluences are when you combine more than one trading technique or analysis to increase your odds of winning a trade. If you have 2 to 3 to even 5 confluences at one point, that gives you enough reason to enter into the stock and protect your downside all at one time. So here is Alibaba. I'm going to delve into the chart and I'm going to show you how I was able to make over $30,000 in 30 days by locating these areas of demands using Fibonacci's to pinpoint when to enter the stock and when to exit the stock. So here is Alibaba on the daily time frame. When I'm delving into a chart, I'm always going to be playing the longer time frames. I'm going to be talking about your daily, your weekly, your monthly. This will allow you not to get faked out from other shorter time frames, talking about your 4 hours, your 3 hours, your 1 minute especially, right? We're always going to stick into the larger time frames to get the bigger picture of what's been going on in the stock. To begin my technical analysis, I always want to identify the trend that's been going on the stock. This is the upper trend line that I drew. You can see every time it hits roughly around this top trend level, it has a retrace. For us, we're going to be finding areas of demand. So we're going to locate all the bottoms, and every single time it hit a bottom, it would retrace upwards. So I drew a trend line from this low point here all the way down to this low point here. And if you extend the line, you can see Alibaba, when it was trading at this level right here, was trading at that lower trend line. Number one, that is one area of confluence that I want you guys to pretty much understand. Then I'm going to use my Fibonacci retracement to identify a deep level of retracement to enter into the stock. So I started my retracement, Fibonacci retracement, from this swing low to this swing high. Remember, I do not want to chase a stock when it's rallying all the way up. I am going to be a patient investor and trader and wait for a deep retracement. Sooner and inevitably, we had a deep retracement into Alibaba. You can see here, once it entered around this area and we were playing around the deeper retracement level of 0.786, this is a deep retracement. That was my indication to start getting interested into Alibaba, the stock. I'll then use the rectangle tool right over here to the left to pretty much locate my areas of demand. As you can see, when the stock was trading at this lower trend line, if you go all the way down to this left here, you can see once it hit around this area, had a huge move upward. We were sitting in a great area of demand. I'm going to bring this over to the monthly time frame so you guys can understand what was happening with the stock at that certain point. So this is Alibaba on the monthly time frame. I'm going to identify areas of demand at that certain point. You can see here from this area, this is the basing candle followed by very bullish movement. You can see the candle right after it, huge movement up over. So to draw demand level, we're going to do the top of the body of this candle all the way down to this wick. You can see here, this top level right here, it was trading roughly at this demand level that we were at previously. I'm then going to go into the weekly time frame to reduce and pinpoint exactly where I want to enter in this position. You can see here that we're at a prior demand roughly around this level and just had a rally upwards. This is a very, very strong area of demand. I'm going to then go into the daily to see how I can then match it up to history. You can see here, every single time I got over here, had a huge rally. You can see in all time frames correlates to very huge movement up into the stock. So what confluence did I see at that time? I saw, number one, we were trading at a lower trend line. Number two, we were trading in an area of demand. Number three, very deep retracement around the 0.786 retracement. Number four, trading very far away from the moving average. Every time a stock moves very far away from the moving average, there's a price action secret called the law of mean reversion. You can see every single time we're far away from the moving average, veers back into the moving average. Far away from the moving average, right into the moving average. Far into the moving average, far into the moving average, far into the moving average. Every single time. That is another bullish indicator for me to enter into the stock position. There's another indicator on top of all of that to pretty much support my thesis that the stock was going to rally. We had an RSI divergence. So when the stock was trading roughly around here, I'm going to do a line from here all the way to here. And then I'm going to draw that line roughly from here all the way to here. You can see the stock was falling down, but the RSI was traveling upwards. This is an RSI divergence. RSI, remember, is a momentum indicator oscillator that is going to tell you whether stock is going to be oversold or overbought. When a stock is falling down, that is usually going to be considered more oversold. But for some reason, the RSI was trading or trending upwards when the stock was falling. This is another indicator that supported my thesis that we were going to start trading higher. If you're able to find this position roughly around this lower trend line, you were able to lock in just at the moving average alone at 8.85%. If you're able to play all the way into the top of this trend line, you're able to net as much as 20% in the position. And that is how I'm able to find these positions, these stocks, time and time after again, while mitigating my risk. Number 4, risk management. Remember, you do not want to lose money in the stock market. We're going to always try to find ways, whether it's 1%, 3%, 5%, to compound our wealth. When you lose all of your money when it comes to investing, you won't be able to invest anymore in the market. You're out of the game. The game we're playing in the stock market is to minimize our risk as much as possible when it comes to investing. So to solve all the problems, you need to be able to have a clear goal. You need to follow an effective strategy, and you need to control your emotions. Managing your risk becomes a byproduct of everything you've done before. Dollar cost averaging. When you begin investing at certain entry levels, you never want to allocate 100% of your funds into that one entry. That puts you into a lot of danger. My rule of thumb is to allocate between 3 to 5 times in the position. So if you've done the proper technical analysis, you want to allocate about 30 to 40% at your first entry. If that level fails and it drops, it'll then fall into the next area of demand. That is when you want to invest another 30 to 40%. So when a stock drops roughly around 4 to 5%, I'll then be able to allocate dollar cost average into my position, going from losing a position that I would be down 5% to down 3 to 4%. So if you have $10,000 to invest, you would be allocating 30 to 40% at each support level or demand level. That's going to equate to about $3,000 or $4,000 at that certain point. Deeper retracements. We always want to invest or trade at deeper retracement. This is going to mitigate a lot of our risk. 62.8% is the level that I want to see used on the Fibonacci levels. This is the deepest retracement when it comes to the Fibonacci levels. It will give you a better risk to reward ratio. Remember, the lower we buy a stock, the less risk we're going to start to entail. It's closer to the end of the correction and nearer to the beginning of a trend continuation upwards. It leads to a higher profitability if the trend resumes as anticipated. We'll then want to look for dips. Don't buy a stock when it has a green day. You want to start looking for opportunity on significant drops. When a stock or the stock market in total drops 3 to 5%, that is when you should be searching for opportunity. That's when many other retail traders start to get fearful and want to get out of the market. That is your opportunity to get in the market. Usually, market is going to overreact to certain news. An example of this is with Boeing with its recent plane door incident causing a massive sell-off in the company. It's a huge company that had a massive overreaction to the downside. Yes, those aren't pretty news to see, but a lot of the issues that are happening with Boeing or stocks that sell off due to poor sentiment at the time, a lot of the issues are able to be mendable. Think of the stock market as like a huge baby. When there's sort of negative news on a certain stock, the stock would just overreact to the news, sell out at ridiculous levels, and ultimately be able to be bought by the institutions at a lower price. They're simply using it as a mechanism to sweep out the liquidity of the retail traders, accumulate those shares themselves, and ride it upwards time and time after again. Part 5, profit, rinse, repeat. So putting everything together that I showed you above, everything starts to become easier. Once you're able to follow everything step by step, you'll be able to make money consistently and predictably in the stock market. This is how I was able to make $30,000 last month in the stock market. Same thing that I've said time and time after again. Evaluate those undervalued companies. Look at the same metrics that Warren Buffett used: revenue, free cash flow, PE ratio. Then after identifying that these companies are undervalued, they are sold out due to poor sentiment at the time, the issues that they have are easily fixable. We'll then delve into the technical analysis. I'll start using supply and demand. I'll start using my Fibonacci. I'll start using Elliott waves. Those are all the indicators that you need to simply use. Then we'll start setting our entries and exits. Everything's pre-planned. There's no emotion. There's no extra time needed. Once the level fails, dollar cost average in. If you're able to profit, take that money and move on to the next play. That leads us into profit, rinse, and repeat. We aim to make roughly around 5 to 10% per month in the market conservatively. Think about how much the market returns with the index funds of 10% per year. If we're able to make this per month, we're able to drastically improve our net worth comparatively to just investing into the index fund alone. Everything here is consistent, it's predictable. Remember, we're in the game of not losing money and compounding our wealth. So stick to the game plan. This is something I struggled with when it comes to trading, letting my emotions control my decisions. I would never stick to a game plan. I would stick to it maybe a day or two, and then if things fall out of my favor, I want to sell this position. Stick to the game plan. You need to set your exits and you need to stick to them. Don't get greedy. Do not get fearful when things start falling down. So like I said, I typically aim to make anywhere between 5 to 10% from each play, but there's some anomaly plays that tends to go off because these stocks end up getting so sold off that I end up making 40, 50, 100% off of these trades. That doesn't happen all of the time, but it does happen. And it happens to these stocks that are at these oversold levels. And this is how I'm able to capitalize on it month over month over month. Remember, opportunity is everywhere. Do not chase any sort of stock. Opportunity is everywhere with this strategy. You do not need to trade every single day. That is the most common misconception about trading in the stock market. The more you start trading, the more you leave yourself to be vulnerable in the stock market, get emotional, start losing your money. Sometimes all you need to do is sit back and wait for those opportunities to present to you. Remember, my goal isn't to become a hedge fund trader. I'm simply in the stock market as my ticket to financial freedom. I don't want to be enveloped in the stock market every single day, trading every single day, bringing up my stress levels, cortisol levels. I don't want to be involved in all of that. I don't want my whole life to revolve around the stock market. I did this for my family and to create financial freedom for all of my loved ones. So the common questions that I get: will this strategy work for me? Simple answer is yes. If you have a computer, phone, or any internet service and you're able to actively invest or trade in the US stock market, this is going to work for you. Remember, I'm just a regular dude. I have nowhere special. I'm not smarter than you. I'm not better than you in any sort of way. I wasn't raised in a high income family. All I did was stick to the strategy, and that's what was able to make me have over 6 figures in wealth. So who is this good fit for? This is a fit for everyone, from the total beginner to the high-level investor. Everyone here is in the market of just making money. If you want to make money, this is it for you. Simple as that. How much time do I need to put in? This is an extremely passive strategy. Remember, I'm not going to be checking my portfolio every single day. I'm not going to be trading every single day. If it hits my certain level, I'll set an entry to buy into the position and then let it be. I probably put about 3 to 5 hours per week. So if you guys have any other questions, make sure to comment down below and I'll be able to answer them for you. If you guys enjoyed this style of video, make sure to like the video, comment, and subscribe for more. Thanks guys. Take care.